Coming to you live from downtown Detroit, this is Benzinga's PreMarket Prep. With your host, Joel Elconin.
This is a volatile puppy here, isn't it?
And Dennis Dick.
I'm bidding a penny. I will buy the stock for a penny.
With everything you need to start your trading day.
Good morning, everybody. Welcome to this Monday edition of Benzinga's Pre-Market Prep. Spencer Israel here with Joel Elconin and Dennis Dick. Got a lot of stuff to talk about on this show today. It was another bad weekend in terms of new cases, and we'll talk about the relationship that the new cases have to the overall market. Facebook in the crosshairs. A lot of companies and brands are leaving Facebook and Instagram and choosing not to advertise there. We're going to talk about the reaction to Facebook shares on that. We're going to recap briefly the action from the Russell Rebalance on Friday. We're going to talk about Gilead pricing remdesivir. Nikola truck pre-orders start today, so keep that on your radar. That could be a mover. And our guest is Steve Sears. He's a Barron's columnist. He would join the show at 8:35. I'll bring Joel on now. Joel, give us a quick week recap here on what happened in the overnight session on Sunday.
Good morning, Spencer. Good morning, traders and investors around the world here. We're up 14 and a quarter handles. We had a dip off that 6 p.m. open, went to 83.50. For you, that's 29.83.50. For those of you looking for our May 29th low, no can do. That was 82 and a quarter. Nice bounce off that level. So that's going to be a huge support level if, in fact, we get back down there today. Not much on the upside, folks. The intraday high for Friday was 30.62. So you're going to have to pick a number in between there unless you just think we're going to rally right back to the intraday high from Friday. You have crude in the green here by 49 cents at 38.98. Gold knocking on the door of 1,800 again. If you want a resistance level, there it is. Up 420 at 1784.50. Silver back over 17, or back over 18, not by much, 1.2 cents at 18.18. Bitcoin slipping a bit here towards the lower end of that 9,000 to 10,000 trading range. Triple D got to talk to you on the weekend a little bit at the event, but the Russell rebalancing, what a dud that turned out.
Whimper. Yeah, it was a whimper. We had a few gaps at the close. We did have some volume. So if you look, you're like, wow, the media is telling all the volume from the Russell, but let's be honest, there wasn't a lot of big gappers. There wasn't a lot of big movers. Most of it paired off fairly easily. You had a couple movers. Let's look at AMT, bring up the intraday of that one. You can see right at the close, got some heavy selling. Went from 252 at around 350, and the imbalance came out. It was to the south side. And then the stock fell about 7 points in the last few minutes. I did trade that one. Bought it on the close and was able to sell it after hours. So I'm already out of it, so I can freely talk about it. The other one I almost got was a small one. It was Red Lions Hotel. It was a delete. I was trying, a couple hundred, like not even, like probably 300 to 400 stocks, trying to get some moves, playing the potential fades, and just nothing materialized. So obviously I was able to get this one. I was also able to get, or I was trying to get RLH because I had a big buy imbalance, and I was like, oh, if this wants to gap up, and it was a delete, if it wants to gap up into the close, I'll sell it. My order was at 249. It ended up closing at 244, and the stock actually traded down to $2 after hours. I don't know if I would have been able to get out of it down there, but there was some stock trading down there. So it probably would have been a good one, but you see these wicked moves sometimes on the Russell. That was two pretty solid moves, but that was pretty much it. There was a couple other smaller ones that moved as well, but overall, the Russell was very quiet this year.
It's funny. Oh, I'm sorry, Spence, go ahead.
Well, Dennis, you did talk about how Friday could be like a topping event for companies that are like Datadog, right?
Yeah.
So if you pull up Datadog there, it did have a big red candle.
Yeah.
On a day, it got added to the index. So
Yeah, and I still think that might be, and if you look here at the rotation this morning, you're seeing this again. Obviously, some of these stocks are trading higher because the market's up here, but tech is relatively weak here today. The growth tech, which, they were just buying these stocks hand over fist. We had a whole list of them we were talking about. DDOG was one of them that could have the potential turn. I also had on that list CrowdStrike, CRWD had a really ugly day. So that trade did materialize if you were selling it. I was hoping I'd get them on the close, but they kind of sold off all day, so they were ahead of it. There was also Zoom, which had a rough candle. It was at one time down about $10. It closed okay. Pinterest, which was obviously due to the Facebook concerns that got hit. You also had, I'm just going through the list, SEDG was another one. It got hit pretty hard. It was getting added to the Russell. Fastly was bucking the trend. It was getting added to the Russell, but just continued to go higher. Fastly and Workhorse both getting added in there, and both of those stocks just say, nah, we're not having any of it. We're just going up no matter what. If you look at them, they're up here again this morning. These two stocks just keep going. The Workhorse WKHS, I'm still in that I have a small position left of it that I just plan on holding on to, and it's unbelievable. The thing goes up 20% every day. I don't know when when it ends, but at this point in time, I've sold so much stock out of it that I'm just got a little speck left in it. So I'm just going to ride it for a while until we get an ugly candle, and then it looks like the top's in. But there's no reason to just call the top on this because the thing just keeps going higher.
Right. And it's funny, you've been talking about how you've been laying off that Russell for years now. And I think what you have when you explained it to me, and I knew this about, you figure it by the market cap, right? Who's going in and who's going out.
Yeah.
If you start tracking that, like here we are at the end of June. I mean, if you started tracking that at the beginning of the year, or even just a couple months ago, I mean, you're doing the math. I mean, something like, you got to figure out where they're categorized. Something like the Zoom. I did see the Zoom. It did make a new all-time high. So I'm going to keep an eye on this one to see if we can pierce through the pair highs, 60.29 and 61.62, trading down a little bit. So all-time closing high, 59.51. That'll be the good number for the week here in Zoom video.
I'd just be careful on all these stocks because that is still a potential. So what I was talking about on Friday's show was these could turn here today, and the potential, longer term tops could be in a lot of these stocks. Peloton as well. They made new highs, some of these stocks, but a lot of them actually had ugly days. So it could still be the turning point. Obviously still to be determined. We'll look back in a month and say, was it or wasn't it? But the rotation here today, and obviously this rotation has changed daily sometimes, but to this morning, it's Facebook's fault. So let's say whose fault it is. This is all on Facebook, but the NASDAQ's lagging big time here today, and that is because of Facebook. But big tech, FANG, Apple's only trading up 0.4%, market's up 0.8%. So you can see, Microsoft only up 0.34%. Tech is seriously lagging here today. Boeing leading the charge. We got some news on that with the MAX. We can get to that in a second, but I do want to start with Facebook because it will be the story of the day. They're going to talk about it nonstop on CNBC. Got hammered on Friday with advertisers pulling their ads. Again, over the weekend, we got Verizon, Pepsi, a number of others. Spencer, give us the details here. Yeah. Just give us the fundamental details.
Advertisement boycott picking up steam here. I guess a lot of brands have decided in June of 2020 that, oh my goodness, there's hate speech on Facebook. Did you guys know that? Because I didn't know that prior to last week, but I know that now. Thank you very much to Verizon and Starbucks and Ben & Jerry's and Coca-Cola and Hershey's and Honda and Levi Strauss. And
all these people pulled this weekend?
Over the last week or so. Yep.
Yeah.
So Unilever, Upwork. Now is the time if you're a brand and you want to, you guys said it on the pre-market show, but if you want to save money on advertising and you want to hop on the train and get some cheap goodwill, now's the time to do it. So
I think this is exactly what you're seeing. There is a lot of, think about the environment you're in. Half the people are staying home and not really going out much. So business is down. This isn't the time where you're going on full cylinders to advertise and your advertising dollars are turning into immediate cash. the advertising right now, some of it is getting wasted because obviously, if you're Pepsi, you're advertising your products. I mean, it's sold in stadiums, bars, it's sold a lot of different places. Obviously the grocery store is still selling the Pepsi, but we know, sales on some of these, especially, the Molson Coors, you think about the advertisements there, and they've been struggling because the bars are closed and the restaurants aren't selling pop as much right now. A lot of them, aren't getting the people that are coming in there, even if they reopen. There's so many places. So if you're Pepsi and you're like, well, right now the dollars just seem wasted anyways, well, this is a good excuse to just pull some advertising. And you're not blaming your own business, you're blaming Facebook. So Facebook, obviously the victim, and social media is the victim here. And if you look, Twitter, Pinterest, Snap all had ugly days on Friday. They're having ugly days here again today. But I think this is more of an excuse just to lighten up on the advertising for a bit. I think the advertisers will come back to Facebook. So I don't think this is a permanent trend. And I do think the stock will be a buy at a certain point. And maybe that's 200. It's a huge level. It's coming up. But I don't know. What are your thoughts on Facebook, Joel? It's hard to catch the falling knife.
I mean, there was a couple red candles, but that was a doozy. That was a doozy on Friday, and now you're just tacking on. So you talked about trying to put it back in long term. I don't have any interest in putting it in long term. You want to wait till it starts going down. Right now, I mean, you're traded just off the lows of the pre-market session, 206.30. So if you feel like you have to own this here at 209, for a swing trade, and you don't want to miss out on that pre-market low of 206.23, you could take a look there. But I guess that's a $3 bounce. That's not bad. You're filling a gap that you had from earnings. Maybe underneath that 204.12, that's another daily low. But man, there's a lot of pressure on this, and I think that you're going to have more companies like doing this before, like you have companies go, oh, I'm coming back. Like, what are they coming back?
Oh, yeah.
What if they never plan to come back?
Well, I don't think that's going to be the case. I think they are going to come back to Facebook. Obviously, they have Instagram product. They have a lot of different products as well that they've got advertisers through. I don't think this is a permanent trend here. So that's why I do believe the stock will be a buy at one point in time. It's got some value. I was mad that, obviously upset, because I sold my long-term stock when I thought COVID was still a major issue, down at 181. And we know I had bought some of that stock multiple times. I bought some at the lows of 135 way back a year and a half ago. I didn't buy more in the recent COVID low, but I had bought some before that as well. So I was anywhere in from like 135 to 160, and I was planning on holding that. I had some of it designated long term, and then we just had all these COVID concerns, and I lightened up the portfolio. And Facebook had a wicked rally. I thought it got a lot of those losses back, and I lightened up. So it was a mistake. So I'm getting an opportunity here. We're 209. It's not 181. I don't think it's going to get down to 181. I would absolutely be a buyer if it got to the 180 level. I just look at maybe I got to start jumping back into my long-term portfolio at 200. Again, this is a long-term investment, not a trade. Trades are hard on the falling knife. A bounce trade at 200, though, is a nice setup there, too. I'm not sure you even get there, but like you said, Joel, they're not going to be coming back anytime soon, and maybe we lose more. I mean, people who were buying the Friday dip saying, oh, this is a good opportunity to get in Facebook, now you get all these other advertisers boycotting, they're regretting that move immediately. So maybe it's going to take a few days to get a lot of people getting up, to get a lot of advertisers pulling their ads, and then maybe it calms down and that's when you buy. But at this point, you're just catching a falling knife. So maybe wait until the knife at least stops going down.
The YouTube chat just posited a pretty good theory after the election, don't you think? Don't you think after the election?
No, man.
I don't. That's so far away. I mean, as a long-term investor, trader,
but they're going to come running back in November.
They probably will. I don't think this is a permanent trend. I don't think it's over. The story's over for Facebook here, and advertisers are all going to pull their ads. They're not going to come back.
Right.
They know Facebook does targeting ads very well. I mean, Google's a victim here too. So Google got hit really hard on Friday as well. So you're seeing all, online advertisement. Facebook, obviously the catalyst here that started it all, but all of them got hit. I mean, Twitter's gotten ugly. I own a small position in Twitter. I'm going to buy more Twitter if it gets down to 25. I'm not sure it's going to get there again. It's 28.35, so I don't know if it gets all the way down there. But I still think these are if you're putting your long-term investing hat on, I don't think social media advertising is going away. I don't think it's the end of it. I don't think it's the end of the story. So have your list ready, and at a certain point in time, this will be a buying opportunity, I believe.
All right, S&P's is hanging out near the highs of the pre-market session. When we were doing the pre-market show, we got a little burst and really took us up another 6 or 7 handles. I know you got picked off on a few things there, but I don't know. I'm not seeing a reason for the strength here. The only thing I could theorize is that the big boys bought a lot of stock on the week close. They bought the futures overnight, and boom, they're just going to unload on the open, and then we could just drift lower. But nice pop, nice green, considering we didn't even get to like the news of the weekend. And I know, Dennis, you did some extra homework on this.
Yeah, I did.
And so let's let you and Spencer take this one away.
Well, and if you just look at the S&Ps, I mean, predicting the day-to-day movement of this is very, very difficult. There's so many different headlines driving. Obviously, we know the cases is the catalyst to drive us down. But I was trying to take some of the noise out over the weekend. And this is my own research. I was tweeting it out, but this is my own charts, my own research that I took from the World Health Organization data. And I just was trying to smooth it over and try to get a good look. So if you can show the chart, Spencer, that I put together there, what I was trying to do was show my case that the S&P rally, everybody keeps saying it's the Fed. The Fed bailed us out. The Fed rallied the markets. And I've been trying to say that's false. And the reason I was saying it's false, because in March, and multiple times in March, that the Fed fired off bullets. I mean, we had the drastic, in between 50 basis point cut, in early March. The market rallied on that for 20 minutes and then went red. So the Fed had 3 to 4 acts during early March, what the market completely shrugged off and ignored. And that's because you had this exponential growth in virus cases. And we didn't know where it was going. And it looked like COVID was going to kill all these businesses. Obviously, that didn't materialize. We got a handle on it. But the reason we turned around wasn't Fed action. We turned around on that Sunday night when New York suddenly, because we had Como was saying, we're shooting for, trying to flatten this curve by the end of April. That's what they were talking about. It started to flatten on the first weekend in April. And that's when the markets really started to turn. And I even tweeted it that day. I was like, we could have a flattening the curve rally here. Well, that flattening the curve rally didn't just last for a couple days. It lasted for 2 months. So let me explain the chart you're looking at. So obviously on the bottom, you're looking at the SPY. And you can see the inverse correlation, which is very, very clear. But what you're looking at here is the weekly increases in U.S. COVID cases. So I'm not just taking the absolute number, which continued to climb. And lots of people arguing, ourselves included, that the market's been completely ignoring COVID because the cases are still going up. But the market wasn't looking at COVID cases in the absolute numbers. They were looking at, are we getting it under control? And when you look at this chart, they got it completely under control because the weekly increases topped out right around that last weekend of March, right when the market bottomed, and then started to come in because we started to flatten the curve. Social distancing started to work, and the weekly increases started to drop substantially. So they were still going up on an absolute basis, but they were going down. We weren't getting as many cases every week. So, and if I go grab the numbers, and I guess I should have brought this up so you can see the actual numbers behind it, but I'll just go grab it. It's in my, just hang on. I'm just grabbing it right now. It's in my computer. I wasn't ready.
This is weekly new cases. I can talk about daily new cases so the record for daily.
Yeah, talk to daily for a second. I'll bring up the numbers.
The record for daily new cases was just over 39,000. That was April 24th. That was the highest. Okay. That was the record until last week. We have now topped that 39,000 threshold 4 days in a row. And we came close on the 5th day too. So the new record, we topped 40,000. That was the headline this weekend. We topped 40,000 new cases for 3 straight days now. 4 straight days. So that's why this is getting worse. That is the trend in a nutshell. Is we have topped 40,000 cases 4 days in a row. We had not topped that prior to last week.
So the numbers behind this, and I'm looking at the weekly increases. So March the 2nd, we started with 124 weekly. That's when we know when the party was getting started. The next week was 1,350 increases from the previous week. So I'm not looking at how many cases went up. I'm looking at the increase from the previous week. Then it went up, 12,000 more than the previous week. Then March 23rd was 74,000 cases more than the previous week, which was like a 600% growth. So just enormous. And that's when everybody was spooked and selling everything, because we're like, where is this going? If it's growing 600% in a week, where is it going? Well, the very next week, we only grew by 82,000 cases. So that actually, the exponential growth stopped on March 23rd. And that's right when the market bottomed. That's when the exponential growth was slowed significantly. So it started to slow down. We're getting hey, this isn't going to take over the world. The social distancing obviously was the big impact there that stopped the cases from growing exponentially. If we were just let it go, it would have kept going, exponential math. And then it started to go down. So if you bring that chart back up for 2 months, we charted in the negatives where the weekly case growth was going down almost every single week. You can see in that chart, it's just showing all those negatives there until the first week of June, when we got our first day of, or when we started to spike back up again. And we know that's the South, when the South started to go up. And then we had a little blip down in June 8th, where it looked like, oh, we're going to get back in control again, and it's starting to come back in. And then the last 2 weeks, we've just, took right off. And that coincides nicely with the S&P sell-off. So you can clearly see the inverse correlation here between the weekly increase in US COVID cases and the SPY. So really, the S&P has just been tracking this to inversely and trading off of it. So if you're watching where it's going, and we've been talking about, this being the concern, we were talking about this 2-3 weeks ago, when everybody was just buying stocks and buying American Airlines and everything, it was starting to become a problem in the South. And I mean, it's logic, right? You can think of it logically, and this makes sense. But it's showing you that the Fed didn't have as much impact in the recent rally that everybody thinks it did. Yes, it helps, when you get free money out there, yes, it helps. But the market has been concerned about the virus the whole time. The virus has still been number one. And even though it was quiet, and we were talking about riots and we talked about everything, really the market was rallying in April and May because we had the virus in check. We had it in control. And then obviously down when we got to June, we know that the South started to have exponential growth, and we've lost, the virus to a certain extent in some states, and that's why the market is concerned again. So I'm just telling you that the market cares very much about the virus. This is the proof.
Godspeed to Connecticut and Rhode Island, the only 2 states in the country where cases are still declining. So.
And there you go. But there's smaller states too. So, and states have all done it differently. But if you look, Michigan's starting to have a few problems again too. It's starting to drift up again. As we reopen, it's inevitable that you're going to get more cases. I mean, there's no stopping it. So I'm not advocating to go and shut everything down here again. I'm not an epidemiologist. I'm not, going to tell you what you can and can't do. I think you should wear masks. It's my own personal opinion. But my job is, as a trader, is to identify what is market catalyst, what is moving. And what I'm telling you here right now is, when you look, at the overall trends here, the virus matters very, very much to the market, not so much anything else. Everything else is just noise, including the Fed right now. Because if we continue to lose the virus, if we continue to see exponential growth, if we continue to see Texas closing restaurants and bars, I mean, that's going the opposite way from what the economy wants. That's going to create major problems here. So, Apple had to close some stores again. So we know as the virus cases increases, you're going to have to see some certain businesses shutting down and trying to figure it out. So I'm just saying, all that matters. It's been this argument the whole time. You can't fight the Fed. You can't fight, it's going to go up no matter what the markets. And maybe that's true in the long run. Maybe it's true. But right now, as traders, there's been money made on the short side. You can argue it all you want, but if you were buying American Airlines saying you can't fight the Fed on June the 6th, well, you just lost half your money, because it's $12 and it was $23. So
I think
you got to be careful with what you're doing.
You got to throw. I mean, and this is the flip side here, and this is what what a lot of people are banking on is like, yeah, there's more testing, there's more cases being reported. But you not are at the point where, to me, like, one scary thing was hearing about the hospital capacity. Like, if you're sick and you can't go to the hospital, when has that ever happened in your life, right? Never. So we were at that point. So right now people are saying, yeah, cases are up, whatever, but not as many people are dying. It's just because we're doing more testing. And that's, that is what is anything is putting some support underneath this market, is that people are just looking past this and saying it. So you gotta, when you talk about the negative, you gotta talk about, what potential positives people are seeing in it. And it depends, like, Houston, and a lot of it's some places like Texas. Texas is like, we got to open up. we're going to do what we want to do. And then, and then you see what happens. So it's a story that, unfortunately, and what we've been saying on the show for a long time, we could come up with our short-term ideas. This is going to be with us.
Yes.
It's going to be with us for 3 months. It's going to be with us 6 months. Pandemics do not come and go in a quarter or a half.
It's not
year
going
or
away
a
in the
year.
summer.
And it's
It's
not going
obviously
away. Oh,
been
yeah.
proved.
I
It's
mean,
not going
how
away
many
with the
people we
weather.
hear? Oh, yeah, the warmer weather is
The
going
warmer
to
weather's obviously not helped here at all. I mean, you do have the case where maybe Florida, Texas people are going inside for air conditioning now. Scott Gottlieb made that point. So maybe that's why the southern states are getting hit a little bit harder right now, because, obviously when March is nice outside, it's 70 degrees in Florida. Maybe people are outside hanging out, doing their thing. And we know a lot of obviously the spread is happening indoors. So you might have that potential where people are going inside now for AC, and that could be driving the spread maybe in these southern states. But it just look at, all I'm saying is you've got to be cognizant if you're trading about the virus numbers. You can't just ignore it and say it doesn't matter, because it does. Everything, this matters more than the Fed. It matters more than anything, at least in the short run here. And that's showing you. I took out the noise in that chart. I went week to week instead of day to day, because you could say, oh, we're up here this morning, but cases are up. You're lying, Dennis. You're wrong. Well, it's all noise. I mean, nothing's smooth and just goes perfectly. But when you go to the week to week data, that chart that I drew up pretty much shows pretty clearly that the market cares about the virus. So, where we were saying the market is irrational in maybe April and May because it's ignoring the virus. Sure it was, but the virus was in check. And now the virus is no longer in check, and the market is spooked here again to a certain extent. So the virus does matter. Obviously, we don't know how this plays out. I think in the long run, we're all going to be okay. I think, the majority of people are going to survive. I don't think it's the end of the world, the zombie apocalypse. But I'm saying as a trader, I'm going to be aware of the virus numbers. And if you were watching the virus numbers in the South 2 weeks ago, you'd be lightening up your portfolio like I lightened it up a week and a half ago. You'd be lightening it up, and you wouldn't be getting dinged here on Friday, and you wouldn't be getting dinged on some of these other days. And maybe this is just another buy the dip opportunity. But I'm not jumping in until I start to see the virus get back in check, because right now we're flying high and people are arguing, oh, but the deaths are low. I had 4 people tweet at me. Well, the deaths, this is useless information because the deaths are low. There was a paper that's put out last week says 24 days the lag. 24 days is the lag from the day you're infected till the day you potentially die. So when you start seeing cases uptick 2 weeks ago, we're not at a point where these people are killing off. Now, we're not going to be as bad as we were. And there's good points being made. You said you got to talk about the good too. We know more about the virus. We're learning more how to deal with the symptoms. We have a couple therapies. Maybe it's remdesivir. We have some therapies that seem to help. So I hope, and I think the case is that the deaths aren't going to take off like they did back in March. But again, the market is spooked. And as traders, you need to identify what the potential catalysts and what the market drivers are. I talked about this weekend in obviously the Benzinga Pro. The first thing I do every morning is talk about the driver. What is driving the bus right now is the COVID numbers. I'm sorry to say, it's the truth. That is what's driving the bus. It wasn't driving the bus in April and May because we had it in check. Riots, hope trade, reopening was driving the bus. Now, again, the market is concerned about the virus. The proof is in the printing. The proof is in that chart. The proof is in the SPY. It's down 7% in the last 2 weeks. It's not down 7% because the reopening is going well. It's down 7% because the reopening isn't going that well. So you got to watch this. As traders, it's important to watch, what the catalysts are.
Correct. And Boeing has a catalyst today, trading up 870, 880, whatever you want to call it.
And somebody says, somebody says Dennis wants the market down. I'm talking the market down. I don't want the market down. I'm 70% invested.
They must be new to the show.
I'm sorry. I'm still 35% invested in stocks. Yes, I have a lot of cash, but I don't want the market down. I don't want the market. I do think I like sitting here and not going to restaurants and I want to go boating this weekend. And I'm trying to figure out, a couple friends are going to the beach. I'm like, well, I can't go to the beach. I'm not going to do it because I don't feel safe to go and hang out with a bunch of friends and get outside my bubble. I can, I've got my little bubble of people. You think I like this? I don't like this. I don't like sitting at home. I don't want the market to go down. I don't want the market to just implode. I don't want to be stuck in my home anymore. So that's absurd. I'm just telling you what the reality is. My job as a trader is to be able to identify the short-term trends and be able to profit from that. This is how I pay my bills. This is how I feed my family. I have no other job. I don't have a day job. Day trading is my job. So this is what I have to do. So I'm looking at data. I took a couple hours to put that together, figuring that out. And I'm like, it's showing that the market still cares about the virus, because people say to me all the time, all that matters is the Fed. They don't care about the virus. It's not true. It's in that chart. It's not true.
Nick Malucci said he loves us even when we're wrong. Thank you, Nick. We appreciate that. And real quick, Dennis, you hinted at it briefly, but Gilead did price remdesivir. It is going to be $390 per vial, which according to the company is well below market.
Well, let's talk Gilead here for a minute. The stock's getting a nice pop here, Joel. It's a play that I was in multiple times. It cooled off. It's put in a nice bottom in the mid-low 70s. So
trading range.
Yeah, it's in a trading range. I mean, now you're getting a pop. It's always not paid to buy the Gilead pops. It's paid to fade them. But it's in a trading range. It's
still kind of in the middle of the trading range. And actually, what's good about this chart is that it's been in a trading range, and the trading range is contracting. So you're going to get a better move out of this one way or another. Just rock solid support. They won't under 72 or just above 72. Is it 72 and a half? Yeah, I remember looking at this a couple of weeks ago. 72.38 was a low, and then how far, 72.75. So under 73, but that's not going to do any good today because it's up 205. Did get a couple spikes to 77. 77 and a half is your pre-market high. So what this has done on previous occasions on this kind of news, it's gotten a pop, and I'd say 3 out of 5 times, maybe 4 out of 5 times, it's seen the high in the pre-market and then kind of faded. So I really like that 77 and a half number. If you're looking for a potential target, I see 78 as a high on June 19th.
And then let's go to Boeing here real fast before we go to our guest. But Boeing, their catalyst is, what do you think? 737 MAX. We have a headline here that they got FAA approval to start test flights today.
Good news for Boeing. Obviously, the MAX has been a major issue. The bad news is the demand for the MAX was obviously non-existent before this because of all the issues with it. But think about where the airline industry is and think about where it's going. It's going to have a long, hard battle to get out of this. Obviously, COVID was the thing that knocked them down, and they got a lot of problems. So is people just going out, and are the airline just coming and buying planes hand over fist? I mean, even if they get the MAX issues figured out, which they eventually will, the demand is inevitably going to be significantly lower than it would have been if the airlines were flying on all cylinders. So Boeing up 5% on a nice pop. I still think Boeing is a reopening stock, and until the virus gets under control, I don't think I want to own it.
And eventual consolidation in the airlines industry. I know that we still have several airlines.
I think so too, Joel.
I don't think we're going to go to GA, government air, but there's definitely going to be some.
But consolidation isn't good for Boeing. If you start losing, if you have to put American Airlines with Delta or something, to start having these things survive, there's going to be less flights. There's going to be less planes needed. I mean, there's going to be less flights all around just for the things like there's some permanent changes here in business thinking.
Business travel.
Yeah, business travel is huge. Business travel is the biggest source of income for the airlines. And people say, oh, well, the business travel isn't going to go away. Yeah, it's not going to go away. The business travel is still going to be there. But does it mean it can't go down a bit as businesses realize that, hey, we used to have, even to go in the CFA Institute, we used to, when I was involved very much with the CFA Institute and the Capital Markets Policy Council, we had the in-person meetings where we flew around, we had people from all over the world, and they flew me to Japan, they flew me to Europe, and they flew me all over there. These meetings, these are hundreds of thousands of dollars in cost, and sometimes millions of dollars in cost, depending on how many people are going to the different meetings, to fly the people in for these in-person meetings. And then they realize, hey, I can go on Zoom, and this is just as effective. And it's not costing us any of these travel dollars. There's no hotel bill. There's no travel bills. There's not anything. Some businesses are realizing that. There's always going to be need for in-person meetings, but there's going to be need for less of them. And that's not good for the airline industry either. There's a lot of reasons not to own airlines.
Airlines, hotel. I mean, even, we're a smaller company, but just, the revenue from events, when we were in New York, flying, hotels, food, costs, it's a major change. And
this event that Benzinga put on the weekend was excellent. I mean, we're over and we're doing it over Zoom, but it's pretty good. I mean, and obviously it's a lot cheaper to run the events this way. I mean, there's still expenses. There's still some stuff that has to go in there, but You'd knock those hotel bills and those flight bills off. I mean, either way, it's not good for the airlines.
Let's bring on our guest here and let's find out what his plans are for air travel. Steve Sears is a Barron's columnist. He's also the author of The Indomitable Investor: Why a Few Succeed in the Stock Market When Everyone Else Fails. Make sure I have him on mute here. Steve, good morning. Let me make sure we can hear you. We can. Hey. Good morning, Steve.
How are you guys?
We're hanging in there. What are your plans for air travel in the future? Have you thought about that at all?
Private jets, only go.
Yeah. When you I gotta start writing for Barron's.
Yeah.
Look, I mean,
private jets. That's a good idea. No COVID concerns on private jets.
Look, I mean, the airline stuff is a hot topic, but let's face it, no one's rushing to go back to work anytime soon. And in fact, I spoke to somebody at a major bank, and they don't even have plans yet to get their guys back. So you think that somebody's going to jump in an airplane and the company's going to say, just go ahead and do things like before and then get sued by somebody if they get sick? I don't think it's going to happen.
So what does this mean for the airline industry? I mean, we see a nice pop in Boeing about the MAX here. We had the significant rally, the retail rally at the beginning of June, where American Airlines doubled in 3 days. And obviously that trade has crashed and burned here. What are your thoughts here going forward on the airlines? I mean, they've come back down a lot from those lows. Is there a potential trade here, or is this just now speculative capital? And
I think it's always been speculative capital. I mean, look, if you want to put brass tacks on it, everything's trading off of COVID-19 headlines until it's not. And then it tracks it, and then it doesn't track it. The Boeing 737 MAX stuff, if you were to back out, all the COVID crap, what you would see is that it's basically doing the same thing it's always done. You get a little bit of news about that plane's going to be back in production. It's not going to be back in production. It trades up, it trades down. That's my view. I heard that I read something earlier today that the airlines are backing away from packing up the planes like sardines, and that air travel was only up 7% sequentially week over week.
I mean, what does that mean? Like I said, I remember Delta saying they need to fly at 65% capacity to break even. I mean, if you do start doing social distancing on the planes, it sounds pretty troublesome to try to get to that 65% capacity. So they're still burning a lot of money.
Look, I hope that they figure out a way to do this, because my brother and I are scheduled to be in Zimbabwe next summer, and I really want to go. But I don't, and I know a number of good friends have traveled back, been traveling on airplanes recently, but they mask up and then they quarantine so they don't get people sick. I don't know what it means. I think we have to evolve, and we're gonna have to come up with some type of a way of super Purelling everything so people don't freak out.
So what industries, airlines sounds like a no touch to you? What are you looking at, Steve, that you think like might be a touch right now, like a good, not necessarily COVID stocks, but what are you looking at?
I mean, I think some of the big tech is looking very interesting now, especially as it breaks down. I wrote about that last week. The crazy thing is, I think the institutions in many ways were caught flat-footed. And I thought they were beginning to jawbone the market a little bit to create liquidity so they could get out. If you look at anything on a given day, the price moves don't seem to really match the liquidity. Things are trading beneath their normal, their average volume. So you look at big tech as people begin to exit out of it, and they were, because big tech has been where people have been hiding. Why? Because there's transparency and there's better liquidity in it. And I think they were rolling out of that into other things, maybe like the airlines. And now who knows what they're doing. But as you look at like Facebook breaking down, Apple broke down last week. What are you going to do? I think those are pretty decent spots to hang out. If you want to play the virus trade, that's super hot too, but that's very speculative, even though people are expecting a first quarter breakthrough.
What about those social media stocks? We really saw Facebook getting hit here yesterday or Friday and this morning. Obviously, advertisers pulling ads. Twitter, though, Snap, Pinterest, all getting hit as well. Even Google getting slammed too. Online, is this just a short-term trend, and eventually the money's going to flow back into here, or is there bigger problems?
I've never seen a stock behave to outside non-financial pressures like Facebook. Have you guys ever seen that?
That's what I said last week, that I don't know if I said this on our show, but I thought that this advertising boycott in terms of the stock would be a nothing burger, because you almost never see the stocks react to things like this.
I mean, we're talking about a potential impact on the stock of like less than 5% of revenue. Facebook remains the key way advertisers reach small and medium businesses. It remains the key way they do mobile direct response advertising, like click here and buy that. But I've never seen anything like it. I think we could be at a turning point in how we discuss things and in the country. And I don't know where that goes. I mean, obviously that's a good thing. Things that have been, dare I say, that white America has known about, but sort of looked past. Now something seems to have changed, largely because of that. I don't know what the young generation is now, the kids in college, but they sort of seem to have a different way of doing things, and I don't know how that plays out.
Gen Z and these companies have just jumped on the bandwagon here. What about Apple here, Steve? You worried about Apple, I think over the weekend.
I did. I mean, it's not going anyplace. It's ubiquitous, and any sort of weakness in that I think is attractive. It's a very hard name to trade, by selling calls against or trading options to try to capture the moves. Whenever we talk about selling puts, that's basically what I call time arbitrage. Let's take advantage of short-term dislocations for long-term gain.
Do you just base that on market sentiment, price action? I mean, because we all know, selling puts in a stock, I mean, cash secured puts. I know you always, recommend that. Is it just, is it just like a timing, like going into earnings where you kind of have, pre-earnings run-ups? What do you base the options? And also, I just wanted to get your take here on just like the overall volatility. And I mean, we look at the actual market in the S&Ps for our VIX, but I'd like you to get your comments on that as well.
So what I look for, I do love the cash secured put strategy. It's been the right strategy now for many years. What I look at is I look at fear. I look at sentiment. Do I think sentiment is more extreme than is merited? Do I think the news flow benefits the position? And then I go ahead and I try to pick an expiration cycle that captures all of these things. And then I try to maximize that, those events that could tilt things in my favor. That could be if I think estimates are on the low side into earnings. It could be if I think sentiment is too negative. It could be that I think the stock moved down or up the other day simply because a big institution adjusted. That's the type of stuff that I look for. And then you're 5 to 10% out of the money. You're within the first 2 months based on vol. I always, for vol, what I look at to try to gauge if I think options are a good buy or a good sell in general, I always start with VIX. VIX is just the general proxy. It's flawed in many different ways. So then I look at SPX, I go 5, 10, 15, 20, et cetera. I always try to stay within the first couple of months of expirations because who wants to pay time premium? You want to let time work for you, not against you, and try to harness theta or decay. And that's about it. And then I'm a huge student of the spread between realized and implied. And then I divide everything by 16 to try to figure out. Do you guys know the rule of 16?
No. Explain it to us, please.
So despite how mathematically complicated options can be, the simple truth is everybody just divides implied volatility by 16. 16 is the square root of the number of trading days in a year. So when you divide, so if something has a vol of 16, it just simply means it is the underlying stock is expected to move 1% each day through expiration. If it's a 1 month contract, it's over the next 30 days, 2 months, et cetera. And that's basically how I sum it up. And oftentimes what you find, because of the way options are priced, they're done by computers, it's very, very programmatic. The programs sometimes fall out of whack with the reality or the news flows. And that's where things get interesting.
We got a couple of events, a very unusual week coming up. We have end of the quarter tomorrow. We have a shortened week because of the 4th of July, and we have the unemployment data coming out on Thursday here. So for these kind of shortened weeks, do you with more volatility, do you make any special adjustments to your analysis?
I might become more cautious, to tell you the truth. Anytime there's a shortened week, you have to, like one of the oldest trading tricks in the book is if you're a dealer is you jack up your vol or you move your vol around to try to offset risk in your book. End of the quarter stuff, people make a lot of a lot to do about that. I think that only really applies to big traders. You have to ask yourself, am I going to get paid for weekend risk? Most of the time during the COVID crisis, you haven't been getting paid for weekend risk. If you're trading, now if you're an investor and you do that time arbitrage stuff I was talking about, probably doesn't matter as much to you. But look, who knows what happens on Sundays when China makes their news announcements? Who knows what happens in bars in Florida, Texas, California? I'm much more cautious and less likely to engage in shortened weekends, shortened weeks like this in general.
I just wanted to touch on one more sector here. You had the stress tests, and oh boy, they were good. And you just had a lot of the bank stocks ripping in the after hours. They ended up giving it back and then some. I know you had some more news over the weekend. These stocks have been slow to recover. They're nowhere near back to February, March levels. Starting to pull back right now. I mean, you get some decent dividends in stocks. Just give us your overall thoughts with the banking sector, especially based on the fact that interest rates, they're not going up soon, or who knows if they're ever going up again. So just your thoughts on the banking sector.
So I was bullish on banks going into the stress test. I thought that they'd be allowed to increase their dividends and do their buybacks, not unilaterally across the board, but JP Morgan, Bank of America, others like that. And I was wrong. I didn't anticipate that the Fed would come out and rule the way that they did. The backstory, after my piece came out, hedge fund manager calls me up and says, listen, I saw your note, but you're focused on the wrong thing. You need to be focused on their collateralized debt and CLO obligations, which are epic. And so my view is that the stress test results are probably in recognition of those exposures, which are said to be quite high at all of the banks. And if that's true, a lot of the stuff is off balance sheet and hidden, then you have quite the risk. That said, here's the fundamental view away from that special issue. You take a look at tech represents roughly 27% of the weighting of the S&P 500. That's kind of the highest since the internet bubble bursting. Financials are down about 10% of that, I think. And so what you're starting to see now at the institutional level is let's rotate out of that which was hot. That was probably some of the weakness last week in tech into that which has been weak. Now, is there a risk to that? Absolutely. But if you're an institutional investor or you like the worship of the altar of mean reversion, and that should give the financials a bid, even though rates are low.
Steve Sears is a Barron's columnist. He's also the author of The Indomitable Investor, Why a Few Succeed in the Stock Market When Everyone Else Fails. He's also the uncle of the VIX, as he says on Twitter. Steve, thank you so much for the time today. And
thanks, guys.
All right.
Take care.
8:48 here. Got about 12 minutes left in our show. Let's look at Nikola here. They have a potential catalyst here. Today is the day that you can pre-order their truck that they don't have really any type of prototype for, but you can order it today nonetheless. So today's the first day of that. Maybe potential catalyst for a stock as hot as this one has been.
This was hot. This cooled off significantly on Friday. They were hammering the stock, and this is a bounce back, snapback rally on a headline. It's usually a selling opportunity, textbook selling opportunity, to be honest. Just the headline comes after a turn in sentiment. The turn in sentiment happened Friday towards the stock. I think you sell this rally.
What I want to know is if the CEO is going to be on TV and he's going to smash the.
When is he coming on TV?
No, I don't know. If he smashes the what did Musk do?
Oh, Tesla with the window.
Yeah, if he smashes the window, I'll buy the stock. If he doesn't smash the window, then
I have a scoop, guys. We are trying, and it looks like we're going to get the CEO of Nikola on our show.
Wow.
Oh, nice.
I don't know when, but I have a call with them today, actually, to try to organize that. So
cool.
That could happen, not this week, but probably next week.
I'm sorry to say to the CEO ahead of time here, though, is the stock, the company, and obviously it's been very hot. The stock's been very hot, but just from a technical basis here, that was an ugly candle on Friday. And that makes me want to sell the rally. So not saying anything bad. The company, sounds like it's going to be firing eventually on all cylinders here, but the stock just maybe got ahead of itself. And I think you had a topping pattern the last few days in the mid 70s. Kramer said it on Mad Money too. And I think it was a big catalyst for why the stock had an ugly Friday, because on Thursday night, Kramer said about Nikola, and he also said about DraftKings. I think it was Thursday night. And he said that, he'd be lightening up on these right now because they've just had big moves. So DraftKings had an ugly couple days, and Kramer probably is catalyst for a lot of that. And obviously this rotation overall, we know some of these Momo names, really the trade came off on Friday. So it's a sector thing to a certain extent too, but snapback rally after an ugly day is usually a textbook sell.
You did get a pop. You were higher. You were a couple bucks higher, right? You went right to 70 even. So there's a nice round number for you. I see the daily highs, just like a lid there. I see the 3-day high at 75, 7 or 4-day high, 75, 71, and 76. So sellers have been coming down. It's been in a range, and the bottom of that range has been, let's call it 62 bucks. So let it bounce around between 62 and 70 here, but big red candle, consolidation after a big move up. It's got to prove that it wants to hold the support there. It's still trading up 445 though at 68 even. Just S&Ps, we almost got to a good daily number at 30.27, turned back at 30.2650. A little bit of a peel back here. So we are holding on to majority of those gains into the open. Important to that pre-market high, the fact that we sold off over $10 becoming more of a factor here 8 minutes or 38 minutes before the market opens.
Imbalance is very mixed here today, and you can see it in the stocks themselves as well. Certain stocks are actually trading in the red. We've talked about the NASDAQ all morning. It's barely hanging green, so tech has been weak all morning. Obviously Facebook and it's all probably the catalyst for that. But when I'm just looking at individual imbalances even in sectors, I see Disney, 55,000 to sell. Stock is trading in the red here. It's typically a reopening play that will move along with the airlines and Boeing. That's not the case here this morning. And even in individual sectors, I'm seeing some stocks strong, some stocks weak. It's a very mixed market. Visa, MasterCard, both showing sell imbalances right now. Visa trading in the red because of that. Some of the oil stocks showing sell imbalances despite oil trading higher here this morning. So you've got some jockeying after that Russell and after, maybe the Friday, sell-off that we saw, where there's some institutions making some calls here, but it's mixed. So Pfizer, 203,000 to buy. That's on the upside here this morning. AT&T, 176,000 to buy. That's a little bit higher here this morning as well. And what I'm quoting is the New York Stock Exchange imbalances that'll show you, how strong or weak a stock is based on opening orders relative to the close. So as of right now, a lot of stocks are going to open very mixed. So just because we're up 15 handles, I'm not seeing strength across the board at all. And that is somewhat concerning for this overall market.
Someone was asking about Pfizer last week. It had a real unusual bad day. Well, it's had some bad days as of late.
Had that drug that really slammed it.
And then, you knocked out the institutional bids at 32 on Wednesday, Thursday, and Friday. You found support under that level. Now you're trading up. Now, to me, if this comes back, this is a slower moving stock. Now, if it comes back to 32, if I could get this stock at 32.04, 32.05, near that close, I have a, clear exit point, right? 31.61, 31.83, even give yourself some more room. I bet you the dividend yield's getting a little bit more juicy after
4.71. It is, Joel.
Yeah.
That gets near 5. I own a little bit of Pfizer. I actually had a bunch and I sold some of it. Just thought it got overdone. I can't remember why I sold it, but it was maybe even before the COVID thing started. I feel like it was like into the run in the end of 2019 when it had the significant sell-off and pharma kind of came out of favor back in the summer of 2019. And then we rallied everything in the year end. And then we sold off. I'd like to get the rest of my Pfizer back. In the low 30s, I'd be a buyer of Pfizer. And they have the wild card, that they're working on, some
they're working on
COVID
drug too, right?
Yeah. A lot of the companies are. I like Pfizer in the lower 30s. So I don't know if you're going to get down $30. If you're buying at 32.04 and putting in your long-term portfolio, I won't argue with you. I've got it in my long-term portfolio. So I don't mind Pfizer here. It is out of favor right now, though. So just be aware. This is a longer-term investing because the trend is absolutely not your friend. But in the lower 30s, you got dividend protection. I don't think the Pfizer dividend's going anywhere. I think the company's still fine. Aging population is still there. I like Pfizer in the lower 30s.
And we're just as we whooshed up just before the start of the show here, we're losing momentum here. We're still up 5 1/4. People are like up or down on the day. I don't know. I think there's a pretty good chance we get back some of these gains. And if you
I think we're going red.
Yeah. And if you actually look at it, let's throw out COVID. Let's throw out all the other factors. Let's throw out the end of the quarter. Let's throw out the jobs number on Friday, Q1, Q2 earnings season.
Thursday.
Thursday. We made a new low on Friday, a low for the week. And we did pierce that level. We did get back above it. But a lot of times you see a follow through from that Friday move. And of course, on the way up, we close on the high for the week, just off that boom. Sunday night, buyers buy, and they take us up. But I've noticed, the last couple weeks, we've had that Friday low, and then once you pierce that Friday low, so that Friday's low was 92.5. We did get to 82.25 in the pre-market. Things really open up on the downside after that. So be careful, folks, under that pre-market low, 29.82.25.
One more stock on my list that's not moving this morning, but it could move today. I'm watching it is Under Armour UAA. This is a Main Street headline here. We've talked about how influential retail has been on the market, retail traders. Under Armour over the weekend announced they were trying or going to attempt to terminate their record 15-year, $280 million deal with UCLA. And they're getting dragged here. They were getting dragged all through the weekend. And
they want to terminate their deal with UCLA?
Yes, they want to terminate their deal with UCLA. This is a record. This is a 15-year deal they signed 4 years ago. They're going to try to terminate it.
Why?
They need to save
They need
money.
money.
I mean, they need money. So Under Armour is getting dragged here all through social media, all through the weekend. Today, too. This is a Main Street headline. I would watch Under Armour this morning. It's not really trading yet, but I would watch this because a lot of people, athletes, are chiming in saying, yeah, this is good for UCLA. Under Armour's trash. Their sneakers stink. Their uniforms stink. And it's just, I mean, they need the money. So,
I mean,
894 low from Friday. You want to see that hold. And I'm looking at the UAA. I mean, you can look at both as UA and UAA. If you're looking at UA, you got to see this thing holds above $8. It starts going below $8. It's could be a slippery slope here again. This stock has been really in a downtrend for a long time now.
Years.
Yeah, we got to go back. In 2016, the stock was trading at $46. It's $8. The time for this stock, the good times, have passed, and the stock's in a clear downtrend. Retail is struggling everywhere. So many better places for your money.
Yeah, I like this overall comment too. I mean, I don't know where we're at in this whole sports world, right? The baseball is trying to get back. The NBA's.
Do we have a date on the baseball yet?
Yeah, there is a date. I don't have it.
I heard what is it, 60-game season or something they're gonna play?
Yeah. July 23rd or 24th, I thought.
I want to see sports. I hope the reopening goes well, for sports too, because I miss and obviously, you've got NASCAR and you've got some horse racing, but I like, yeah, it's not, I like my hockey. I like the baseball. I'll watch the football. I'll take even basketball at this point in time. I'm not even a basketball fan. I'll take anything. I'm hungry for sports.
Well, my point was, you look at, Nike had that bad day on Friday, up near all-time highs. I just don't know. I read an article about, Michigan athletic, department. They're going to show a huge deficit here. I think that's, something that supported, this economy and has been just like a huge driver for stocks like Nike and ESPN. Just as like we don't know the course of the pandemic, how it's going to play out. I mean, I never see 100,000 people back in Michigan Stadium again, and I'm certainly not going to be one of them. I think
you've been saying this for a while, and I completely disagree with this. I think eventually, once we're past, and I think next year, no, I think you're absolutely right. I think a year out here, people are spooked. These stadiums aren't going to even maybe be allowed to be as packed as they are. But I think when we look past like 5 years from now, I hope that the world will be back to kind of the way it was. I mean, we got past the Spanish flu. I think we're going to get past COVID. I don't think this is like a game changer for the world forever. I hope it's not. I hope we're not going to be spooked forever and we're in masks and half the population isn't going to go out to restaurants. I like going to sporting events. So, maybe it's just hope talking, but I don't think it's a permanent trend. But you do make a good point that in the short run, next year or two, I mean, a lot of these professional sports teams, I don't know how do they survive? Like, I mean, some of these were, and obviously, some you don't talk to Yankees, and we're not talking to Toronto Maple Leafs of hockey, but some of these smaller franchises, like the Arizona Coyotes, which were struggling to survive in, the NHL before any of this stuff happened. Now they still got their payrolls, and yes, maybe the players got to take some, some cuts here, but with no stadium, with no, and they don't have the big TV rights deals that some of the major sporting teams do.
That's where the money is.
It's
no
tough.
Pepsi. Yeah.
No,
okay. Let me back that up here. I don't think sports is gonna. It will reemerge and it will be important. But I think when people look back at this, it's not going to have the same kind of emphasis that people have. It's not going to attract the same kind of money that it did in the past.
I disagree. I think I know you have been saying, I just completely disagree. I think you're right in the short run. I think it's a problem, but I think in the long run, I think people are going to come back and want sports. Like I said, I'll watch basketball right now. I'm so desperate for sports, Joel. I don't even like basketball. I'm just not a basketball fan. But NBA playoffs start next week. I'll sit there and watch it because I'm hungry for sports. So you're getting a new fan potentially. Because I can't watch hockey right now. If basketball starts next week, I'll watch it. I couldn't bring myself to watch NASCAR. I don't know. I'm just not a NASCAR fan. And, obviously there's some hardcore NASCAR fans out there. Nothing against you. I've just never really been a fan of it. But I want to see some, Major League Baseball, hockey.
I wouldn't want to be a senior in high school right now, like a 5-star NBA, potential kid going to college and stuff. The kind of money that you saw in the past, I just from the TV rights and from the stadium rights and everything, I think you've seen the top there. But we'll see, right? You just have to see.
Sorry about the random commercial, folks. That was my mistake.
What's going on there, Spencer?
Yeah, no, I just hit that button.
Showing commercials in the middle of
commercials.
I just hit that button by mistake, and I didn't mean.
Dennis talks too much. We just put a commercial.
No, I apologize. That was totally my fault. Sorry about that, everyone. My mouse kind of lagged there, and then I hit the commercial button. Okay. Hopefully the commercial's over by now. But let's wrap it up here. I want to thank our guest, Steve Sears. Thanks to all of you in our chats. If you're in our YouTube chat, please hit that like button. And if you want to give us a super chat and donation, that would be awesome. We appreciate that. We got $5 donation today, so thank you very much.
Get paid this week.
I'm getting paid.
Hit that like button. Subscribe to our channel. You get notified when we go live. We've also got the chat on premarket.benzinga.com and on Benzinga Pro. You can also find us there. Catch our podcast on whatever podcast platform you choose: iTunes, SoundCloud, Google, Spotify, Stitcher, TuneIn. I think that's all of them. And please remember that all the information from our show is meant to be used as informational purposes and not for investing or trading advice. Everyone have a great rest of your Monday. Joel and I will be back at 3:40. In the meantime, stay safe and good luck.